Alex, Mia, good morning. Thank you for stopping by today. I hope your day is going well. Today I would like to discuss the inherited assets of the children. Inheriting these assets can be a great blessing. It's a great way for them to start off their lives financially as an adult or to start funding for college. Aunt Belle was very generous to leave these assets to the children. It does come with some responsibility, though. The most important thing to address is the taxation of the funds. They are very different in that there are three different types of assets that they inherited, and they come with varying current and future taxation. We'll start off with Bradley. As you can see here, Bradley inherited municipal bonds. The date of death valuation was $50,000. The original cost basis was $20,000, but because they were inherited, he gets a stepped up cost basis to the $50,000, which was the date of death valuation. This means that that full amount is post taxes. So when that is withdrawn, that amount would not have to be taxed on the inheritance. You would not have to pay taxes for the inheritance either. Subsequent years' income payments on the municipal bonds will not be taxed on a federal level, as you see here, because municipal bonds are federally tax exempt. It will, however, be subject to state and local tax unless you are a resident of the issuing state, and the bond indenture agreement allows for that exclusion. Now, we can take a look at those and determine where she purchased them from. As you see over here, if the municipal bond is sold before it matures, it would be listed as a capital gain and would be taxable as ordinary income, or as a long-term capital gain, which typically has a lower rate. So that's Bradley's. If we move on to Bria, she actually inherited preferred stocks. The preferred stock has a date of death valuation of $48,000 with a original cost basis of $10,000, just like the municipal bond. And similar to that, it does get a stepped up cost basis to the $48,000. So she would not have to pay any taxes on the inheritance itself. Subsequent years' dividends will be federally, state, and locally taxed at levels of long-term capital gain rates as long as they are deemed qualified dividends. Non-qualified dividends are going to be taxed as ordinary income. So in order to be considered a qualified dividend, it must adhere to a couple of these rules here. So the dividend must be received by a domestic company or a qualified foreign company. And unlike regular stock, which common stock typically needs to be held for more than 60 days during a 121-day period, beginning 60 days before the ex-dividend date. With the preferred stock, it's actually a little different. It would actually be it would have to be held for more than 90 days during a 181-day period, beginning 90 days before the stock's ex-dividend date. Now, I think at this point we should be in good shape because it's been some time since it was purchased by Aunt Belle. So if the preferred stock is sold at any point, the owner, in this case Bria, would realize a capital gain or loss. These gains or losses can be either short-term or long-term in nature, depending on how long the stock was held, similar to the municipal bonds. And the gain or loss will be the difference between the value of the stock at the time of the sale and the stepped-up cost basis we received at the time of Bria inheriting the stock. So finally, we'll touch base on Blair's. Hers is a little different. She inherited a non-qualified single premium tax-deferred annuity. So the date of death valuation is $40,000, just like the other two. The original cost basis was $10,000, but there's no step up in the cost basis for this one. So the cost basis will remain at $10,000, and there will be no taxes upon the inheritance, just like the other ones. Subsequent years' earnings are not taxable as well because it isn't a single premium tax-deferred annuity. Where the difference comes in is when you sell a portion of the annuity, the cost basis itself is tax-free, so that $10,000, but the difference, that $30,000, the earnings, would be taxed as ordinary income to the owner, in this case Blair. So if you choose to annuitize this over Bria's lifetime, the distributions will be taxed to her using the marginal tax rates for estates and trust, being that she is a minor and doesn't have working income. She can use the annuity exclusion ratio to determine the amount of the payments that would be taxable. So this is determined by us taking the cost basis, that $10,000, and dividing it by the total expected return at the end of the annuity, which we can determine once we run some numbers on the annuity. You would then be able to exclude that percentage of the income each year. Conversely, if you do annuitize this, as you see here, you can choose to take the funds as you need, and if you choose not to annuitize it, you would be able to take the funds as you need, and we would use the last in, first out method. This means that the earnings would be taken out first and considered ordinary income, and as you eventually get to the end, the last $10,000 would be the cost basis, which would not be taxable income. So those are kind of a snapshot of each of the three there. Now, because in this scenario they are all minor children, special rules do apply. When the annual total for a child's investment income is greater than $1,200, then a return must be filed for them. In 2018, the children's marginal tax rate is 10%. If it's 10%, they would be eligible for to use the 0% tax rate for qualified dividends and long-term capital gains. So our goal here is going to be to keep the gains to $1,200 or less, so then there will be no taxes to be paid. So finally, I have here, as you'll see, some recommendations. So I would recommend selling Bradley and Blair's funds, Bradley's municipal bonds and Blair's preferred stock. We can use this to start funding for college, as I discussed earlier when we touched base on saving for college to pay for their college education. And this would allow us a smaller lump sum or lower monthly contributions to the college savings, because we'd have something to start with. Now, Blair's, as I went into, is a little different with it being a non-qualified annuity. It's a little more complex. She would not get that stepped up cost basis, so there would be immediate taxation if we liquidate everything. Since Bell purchased the annuity after 1985, it must be distributed when it is inherited by a non-spousal beneficiary, in this case her great niece, Blair. So she would have three options as to how to distribute the funds. We can take a lump sum distribution, as I mentioned. We can annuitize it over Blair's life. And then finally, she can choose to withdraw it within 5 years, within 5 years of Bell's death, but over the 5 years, taking distributions out. So a total distribution of the annuity would be taxable income, and everything that's not cost basis, about $30,000, would be listed as income in the year. And anything over that, like we said, $1,200 standard deduction would be taxed ordinary income. So if we can avoid that, obviously that's going to be our first thing to try to do. The distribution over her life would not have, like we said, major tax. Distribution over her life would not have major tax implications if we were to annuitize it over Blair's life, but it would not be as useful as the 5-year distribution, because if we're doing it over her life, we wouldn't be able to use the full amount to fund her college education. So by taking the distribution over the next 5 years, we can keep her taxable income below that standard deduction of $1,200. And all of the earnings would come out tax-free in that method, and we would be able to have it all invested for her college savings over the next 5 years. And ideally, it sounds like that's going to be one of our biggest things to do. So we can go into that a little further once we get some more details on the investments themselves. But at this point, those are going to be my recommendations for the inherited assets. So in our next meeting, if you have some more information on the individual investments, so you bring that over, we can take a look and fine-tune this a little more. Thank you. Next, we will be getting into the qualified medical conditions for the long-term care. I'm going to grab a drink real quick, and then we'll get back to that. Okay, thank you.